Let's talk about foreign currencies and converting foreign currency amounts into US dollars. Now, we're going to have occasion to convert from a foreign currency to the US dollar or vice versa occasionally. Generally, it's going to be a matter of converting from a foreign currency to a US dollar. We may buy goods from an overseas vendor with the invoice expressed in a foreign currency. We may have an investment in a foreign company or a foreign subsidiary whose value is expressed in a foreign currency, and basically to put that into our accounting system, which is measured in dollars, we have to convert it to dollars. Now, to do this, we're going to need to use an exchange rate, which shows the relative or proportional value between two currencies. Basically, it expresses the price of the foreign currency in terms of the US currency, or vice versa, it expresses the US currency in terms of a price in the foreign currency. An exchange rate may be given either as a direct rate or as an indirect rate, and they will not explicitly say this is a direct rate or this is an indirect rate. You need to be able to pick up on this either from the context or from the way the rate is written. The direct exchange rate is the dollars per foreign currency unit. So this would be sort of the more intuitive way of saying it. The British pound is worth $1.48. The euro is worth $1.10. The yen is worth a little bit less than a penny. The peso is worth, I have no idea what it's worth now, but basically it expresses the foreign currency unit in US dollars. To make this more confusing, the direct exchange rate is written as the foreign currency slash US dollar, or simply foreign currency USD. Now, if I see GBP, Great Britain Pound, slash USD, I want to read that as pounds per dollar. You say, miles per gallon is miles slash gallon. Dollars per pound of, in physical quantity is dollars slash pounds. The way foreign currencies traditionally are written, GBP slash USD means Great Britain Pound expressed in US dollars. Again, $1.48 per pound. The indirect exchange rate is the inverse of the direct exchange rate. It's foreign currency units per dollar. The Japanese yen is traditionally quoted in an indirect exchange rate, yen per dollar. And right now it's about right now it's about 110 yen per dollar, I believe. The indirect exchange rate is written as USD JPY or USD slash JPY. And again, that's US dollars expressed in Japanese yen. These are exchange rates from, I guess about a year and a half ago, March 26th, 2015. And here we have various exchange rates. Euro slash USD, again, that means euros expressed in US dollars. The euro is worth about $1.08 US. Likewise, AUD slash USD, Australian dollar per US, Australian dollar expressed in US dollars. The Australian dollar is worth about 78 cents. The British pound slash USD is dollars per British pound. And now we have the indirect exchange rate, USD slash JPY. That's the US dollar expressed in Japanese yen, 119 yen per dollar. Now, let's look down at the very bottom one, the US dollar slash Swiss franc. And again, that is an indirect exchange rate. It's the US dollar expressed in Swiss francs, which means that $1 is worth about 0.96 Swiss francs. Now, in the case of the British pound has always been worth more than $1, so if you see the exchange rate 1.4 or 1.3 or 1.35, you know that is dollars per pound. Similarly, if the Japanese yen has always been worth substantially less than $1, often less than a fraction of a penny. If you see an exchange rate for the Japanese yen of 110 or 90 or 125, you know that is an indirect rate. That's yen per dollar. In the case of the Swiss franc, though, one that's near what they call parity, where one foreign currency unit is worth about $1 US, whether it's the Swiss franc, the Canadian dollar often approaches parity, the Australian dollar occasionally approaches parity to the US dollar. The problem then is, if you simply say the Swiss franc rate is 0.96, you say, well, gee, is that 96 cents US per Swiss franc, or is that 0.96 Swiss francs per US dollar? So you need to be aware of, again, the way the exchange rate is written. In the case of the Swiss franc, it's USD/CHF. And again, that tells you that this is an indirect rate. It's expressing the US dollar in terms of Swiss francs, which means that a US dollar is worth about 0.96 Swiss francs. Okay, for this course, our main goal is going to be to take a foreign currency denominated trial balance and convert it to US dollars. If we have a foreign subsidiary and we want to prepare consolidated financial statements, we have to express the foreign subsidiary's trial balance in US dollars. We can't add $1 million and a billion yen. They're apples and oranges. They're different currency units. So we have to express everything in US dollars. This conversion is referred to either as remeasurement or as translation, as the case may be. The difference between the two is based on the idea of what's called the functional currency. And I would encourage you to Google, or whatever search engine you use, the term functional currency. You'll get a lot of hits describing what this is and giving examples of how to determine it. Basically, the functional currency is the currency of the main economic environment within which the subsidiary operates. Now, if we own a majority of a Swedish automaker, Volvo or Saab, which builds cars in Sweden and sells them throughout the world, the functional currency is probably going to be the Swedish kroner. They incur expenses and generate cash flows in that currency. If, on the other hand, we own a manufacturing plant in Mexico to which we ship materials and then ship back finished goods for sale in the US, the functional currency might be the US dollar. Again, all that's happening in Mexico is that they're taking raw materials which we send them, converting them into a finished product, and then they're sending them back to the US. They're not generating cash flows in the US dollar. Now, if the functional currency is the foreign currency, and again, this is going to be the most common situation where we buy a majority stake in a going concern in another country. This going concern in the other country continues to operate as an independent company, then we're going to translate from the local currency to the US dollar. So for example, if the local, again, using our example of say a German subsidiary, the local currency is the euro, the functional currency is the euro, and again, that's the currency of the main economic environment within which the company operates. So we're going to translate the numbers to the dollar. If the local currency is not the functional currency, then we're going to remeasure from the local currency to the functional currency. So again, using the example of the manufacturing plant in Mexico, the local currency is the peso. So they would keep their books in the peso, but the functional currency, the currency of the main economic environment within which the firm operates, is the dollar. So they're going to remeasure from the peso to the dollar. The reporting currency would be the dollar because, again, we view this from the perspective of a U.S. parent corporation, and we need the financial statements expressed in dollars. The most confusing case, of course, would be where the local currency is the peso, the functional currency is the euro, and the reporting currency is the dollar. So in that case, the first thing we do is remeasure the local currency into the functional currency, and then we would subsequently translate the euro trial balance to a dollar trial balance. Now, remeasurement and translation differ in two ways, and the first of these is the choice of exchange rates. Now, you would think that the simplest thing to do, and it would be the simplest thing to do, would be to take the subsidiary's trial balance, and if it's measured in British pounds, say, look, the rate for the British pound today is $1.30 per British pound. I'm going to take the entire trial balance and simply multiply it by 1.3 to get the equivalent dollar values. But that's not what we're going to do. Basically, we're going to apply different exchange rates to different financial statement elements. So assets and liabilities might be converted at one exchange rate, equity accounts at another exchange rate, revenues and expenses at a mixture of exchange rates. So basically, we're going to have to choose what exchange rate, whether it's the current rate or some historical rate, what exchange rate gets applied to what financial statement element. So remeasurement and translation use a different selection of exchange rates to convert from the foreign currency to the US dollar. The second issue is that when we convert a trial balance that balances in euros to one measured in dollars, since we're going to be using different rates for different financial statement elements, it's virtually guaranteed that the resulting dollar-denominated trial balance isn't going to balance. Again, if we used a single rate to convert all of the foreign currency amounts to the US dollar, then basically everything increases by 30%, for example. For the British pound example, if the exchange rate is $1.30, we multiply all the British pound amounts by 1.3, and basically everything increases proportionally. If we're going to use different exchange rates for different financial statement elements, we're going to lose that balance in the trial balance. And so we're going to force it to balance. We're going to have this out of balance US dollar measured trial balance. We're going to force it to balance by adding a translation or remeasurement gain or loss. Basically, we're going to be adding a plug figure. And if the plug figure is a debit, that's going to be a translation or remeasurement loss. If the plug figure is a credit, that's going to be a translation or a remeasurement gain. Now these differ in what do we do with the translation gain or the remeasurement gain. Under remeasurement, which is much simpler as far as this aspect is concerned, under remeasurement, the remeasurement gain or loss is simply treated as another gain or loss on the subsidiary's dollar-denominated income statement. So when we prepare the dollar-denominated income statement, we'll have sales minus cost of goods sold minus operating expenses, etc., plus the remeasurement gain, or minus the remeasurement loss. The remeasurement gain or loss is rolled into income, it goes to retained earnings, and we never worry about it again. Under translation, the remeasurement gain or loss is not included in our regular income. Instead, it's part of other comprehensive income. And so we're going to have to carry that forward as accumulated other comprehensive income from year to year. Again, the translation gain or loss and the remeasurement gain or loss, they don't exist in the subsidiary's euro-denominated trial balance or their British pound-denominated trial balance. That gain or loss doesn't exist in the subsidiary's accounting system. It only exists when we convert the foreign trial balance to US dollars. So it's strictly a creation of our worksheet process.